The regulatory pressure on banks over the last 5 years has been inexorable, but that isn't going to change into the near future. The next 5 to 10 years will be just as tough. I think it'll start at the top. The UK senior managers regime has already led the way. That's now being rolled out to the 50,000 firms that are regulated by the FCA and the PRA. Hong Kong has followed suit with its manager in charge regime. In Australia, there's consultation on BEAR. My guess is Singapore will be next with their own version. But the essence of those new regimes is very simple. Up-to-date statements of responsibility for senior executives and responsibility maps that capture the governance framework for organizations. It's very easy, therefore, to see that other regulators will look at that and say it's a very attractive basis upon which to hold senior managers accountable. And I think the political will to hold those senior managers accountable is there. It's always tough when you take an action against a senior individual. You expect a fight right the way through the process. But it's clear that the politicians have driven the debate, the regulatory debate, to a point where regulators are expected to take that fight on. More generally, the changes in respect of technology and the use of technology have also driven a new awareness around cybersecurity risk. It's an area where failure is inevitable. It's inevitable that there will be attacks on financial institutions and inevitable that some of them will succeed. And the regulators, aware of that, are struggling to understand and to articulate how they should express the standards to be expected of financial institutions in a situation where failure is inevitable. They've started by prescribing new levels and standards for encryption, expectations around the assets and understanding of the risks in respect of cyber breach that each financial institution runs. And beyond that, they're now starting to really push hard on reporting. And so the very tight timeframes that were first introduced in Singapore for reports of cybersecurity breaches within 2 hours, now being picked up in Europe in the Payment Services Directive, where it's 4 hours, but where the template for disclosure is very, very prescriptive. And you can see that other regulators will take a similar view. That puts financial institutions in a very uncomfortable position when it comes to cyber breaches. It's typically the case that when a cyber breach is first detected, very hard to know what's happened, who's behind it, how far they've got, and what their motive is. And yet within hours, you're expected to be reporting to the regulator. That's a deeply uncomfortable position. And from there, the expectation that you will resolve the issues, which may mean very difficult publicity, protecting the position of those whose data might have been compromised, and a real struggle to get to grips with, contain, and prevent further incursion can be, again, extremely challenging. On the product side, there are initiatives which I think could have the potential to completely change the distribution framework for retail products. So historically, manufacturers, on the one hand, have been comfortable handing off products to distributors, and it's the distributors who've faced the liability in respect of the sales process. I can see that changing as the expectations grow for information flows up and down the distribution framework throughout the life cycle of a retail product. That's most evident in the proposals that will be introduced in Europe during 2018 under MiFID II, where manufacturers and distributors alike will be expected to identify a target audience, and indeed a negative target audience, and then throughout the life cycle of a product, will be expected to exchange information about the performance of that product, the impact of changes in the macroeconomic environment on that product, the way in which the product is being distributed, the people to whom the product is being distributed. That, I think, may lead the courts in turn to impose liability in respect of the manufacturer of that product towards the end user. And again, I can see regulators across the globe looking at that as a model and raising their own expectations using MiFID II as a basis and a template for that. And finally, I think we'll see the convergence of two areas of regulation. Financial services regulation in the usual sense on the one hand and competition law on the other. Cases that in the last few years might have been dealt with as financial services cases, for example the rate setting cases or the FX cases, which were characterized as conflict of interest cases or misuse of confidential information cases, will, I expect in the future, be dealt with primarily as competition cases. And not just those big collusion cases. I think we'll also see the advent of the use of competition powers in respect of one-to-one communications between bank executives, where they can be characterized as in some way lessening the competitive landscape. I think that's a trend we're already starting to see in the UK. To some extent in Europe, there are moves afoot to increase the competition powers in the regulatory space in Australia, and again I think we'll see that as a trend across the piece. We'll see it also impacting on the whole range of areas where banks work together as syndicates or work together in partnership to deliver products and services.